What's up, guys? This is Carter Thomas with Coin Mastery TV. We are back. I don't know how many months it's been. It's been a while, and it's good to be back. It's good to see you. It's good to talk to you, hear from you. Yes, we are back right as the bull is raging its horns. So, very exciting times. First and foremost, this is not professional advice. It's not financial advice. It's nothing. It is just a guy on the internet talking about stuff, crypto, domination. Absolutely having a great time doing it. And today what we're going to talk about is we're just going to jump back into the old flow, right? As many of you seem to be, looking forward to. We're going to talk about the micro, which is like actual Bitcoin price action. We're going to talk about what's going on from my perspective. We're going to talk about a few different things around Bitcoin and around what's going on with Bitcoin. We are going to talk about strategies for what one could do in this situation in terms of should you buy, should you sell, what the F, like what do you do? I don't know. God, is it banana town? Help me out. So I'm going to give you a few just like ways to think about that, right? Just ideas and pieces of potential strategies that you could execute on. And I'll tell you what I'm doing as well. Talk about a little bit about like the overall market and give you a few ideas that I've had, especially since I have been spending a good amount of time like in crypto and talking to people in crypto and following to a certain extent, but I've spent a lot of time outside of crypto, but looking in as if crypto and Bitcoin are assets. So I want to give you a few ideas that I have about that, about where this may be going, where some opportunities may lie, that I just see, and they're just predictions. I have no idea if it's going to happen. And then finally, or I should, second to last, how does crypto fit into the global market, right? What does the future of this asset look like? And obviously nobody knows any of this, but I do think that there are some signs that are starting to point to a very clear potential outcome, which I want to talk about specifically around inflation and how this is all going to play out. And then last, for anybody who's interested, I'm just going to share a little bit about what I've been doing for the last, I don't even know, like almost a year now. Maybe it's 9 months. Just a few top level things. Some of you may be interested, some of you may not be interested, but I do think that it's always interesting to hear from people that maybe you've been following for a while and you're just kind of like, hey, what's up, dude? Like, what have you been doing? So we'll start with that. Let's go. For anybody listening on the audio, I am pulling up the Bitcoin Tether chart. We're not going to get into Tether right now. That's kind of a whole separate discussion. A lot of it, in my opinion, is just speculation. And who cares about speculation right now? Like, let's wait until we find out actual stuff. And then we could talk about it, like how people react to it, because otherwise it's just pure entertainment, right? And always remember that, right? Anytime you're spending your time on stuff, thinking about stuff, wondering like, is there any facts here? Is this worth making a decision about yet? And in my opinion, it's not, right? Once it is like a definitive thing, then you can make a decision from there. But anyway, we're on the Bitcoin Tether because that's where the most spot volume is, not futures volume, which is like BitMEX and all these other futures-related exchanges, I should say. And we can see that this is pretty clearly on the upside of a clear bull trend. Let's be honest here. Back in February, I told a few people, hey, I think this is a really good time to start dollar cost averaging. I don't know if this is the big one or if it's not. Looks like it might be, but again, nobody knows. But I do know that when you have this much bull energy, when you have this much sentiment driving it, you get to a point of no return. And even with a catastrophic collapse of whatever it may be, there's enough bull energy back that I think has proven that this is not going to go to zero. And anybody who does think that Bitcoin is going to go to zero, you're probably watching the wrong channel. Like, this is just a belief I have. And I don't think that really is a possibility at this point anymore, just based on what's been going on and how hard this asset has been stressed. So I think you can very confidently say that, yes, it could easily retrace. It could retrace very deeply, like way below the lows, but it's going to come back. And when you have that level of certainty, or when you have that belief system down that whatever happens, it's on its way up, you start to go into the stock market mentality. And that's what we're going to talk about in a few minutes here with kind of different strategies and things like that. So the most recent, I guess, let's call it month, we've just gone essentially vertical. You've seen a lot of people on Twitter, maybe on YouTube, for anybody who's been watching, drawing the parabolas, showing that we actually are in a parabolic move right now. And then coincidentally, last night we had a bit of a blow off top. We're going to see if this ends up following a very similar bubble, diagram, where it does that kind of NASDAQ 1999 thing, 2000, where it bounces back up a little bit. And if I pull this into the 1 hour as opposed to the daily, right, theoretically it could come back up to 7,100, and then it would kind of slowly pull back until it got bought back up, and then we're back into a larger bull run. But what I'm doing is I'm looking at this and saying, okay, let's say you have some fiat or you have some stable coins. What do you do in a situation like this? Many of you have been here on a grander scale, right at the end of 2017. Some of you were here, or not at Coin Mastery, but just in general, last summer, 2 summers ago now, where we had a big pop in altcoins, Ethereum, ICOs. So how do you play this? What do you think about? Well, I think the first thing that you think about is what's going on with the price action. And there's a few things to think about. The first is down here at, let me move over. Let's call this 4,400 on the Binance. So this area where this is big kind of straight up shot, this is typically what would be a gap on regular markets. So if this was not a 24/7 trading market, that would most likely be what a gap is. And if you don't know what a gap is, let me just jump over. I'll get ahead of myself here. A gap is when there is a break in the price action because of something like the weekends or holidays, and you got big news on the weekends, and so it opens or closes at a different price than it closed at the week before. Do you see what I'm saying? So there's always going to be a gap. And typically, especially in the futures market, those gaps close. Sometimes they close immediately. Sometimes it takes weeks, months, who knows. And so you can see that like on the futures chart, there's some gaps here and there. And these typically get filled. Now, if you notice CME futures, which is by far the biggest volume futures, it closed at 62.90. Right now, Bitcoin is trading at 6,900. So when you go down and on the very immediate price action level, realize that there's going to be enormous short pressure coming in to the Bitcoin ecosystem today, right? It's Sunday. And then tomorrow, Monday, when the cash index is open and you can start to short all these proxy stocks like Overstock and GBTC and everything else to try to close that gap. This is how markets work. And then when you go down here to this 44, there's going to be a lot of pressure to try to close this. Doesn't mean it has to happen because this is not technically a gap, but there is a case to be made to come close this down. So the highest probability is that this futures gap is going to close down to 62.90. So you can put a very high probability that's probably going to happen. The second highest probability is that it's going to come down and retest this resistance level. Let's call it 5,200 to 5,500, somewhere in there. That's also maybe like 70% probability. And then down here, this big bar that went straight up, this should happen, but it doesn't have to happen. And so maybe you get to like 60-ish% there, but you're going to get a much better price. So you can start to see how the risk reward in terms of if you want to buy in changes. So what I want to do is I'm probably going to layer my bids, right? So I'm definitely going to start with the CME gap, right? So right around 62.90 or 6,300, give or take. And it usually overshoots it. You can see there's a gap down here at 6,100 as well. So it could easily just spike down. You get a big fat finger and that closes it out. Excuse me. But I think that's where I'm going to start. And then I'll have heavier bids layered down to, right, this kind of this natural resistance, which ideally should be a support zone. And then I'll have a big bid down here at the 4,400. And then after that, it really just comes down to either waiting because you believe it's going to be a bull run, which I do, over the next 6 to 12 months, or you go find some more fiat and you buy back in. But that's the way I'm going to do it in this particular situation. Now, that being said, I think that there's also a very good case to be made for just dollar cost averaging, like we talked about. When this thing starts to go, as it's proven that it's going, when you think about the 9 innings of a baseball game, in momentum trading, which is really kind of finding the trend and playing the trend, which is what crypto is all about for the big money. I personally think we have proven that we are in inning 2. Like, we have proven that we've hit a potential low, and even if we retest that low, there's enough upward momentum that's going to come back from it. So I believe we're in inning 2 of, let's call it 9 innings, which may go into 2021 or 2022. Who knows? I personally find that in crypto, I do much better when I play those innings 2 to 7 or 2 to 8. And I don't try to do the tops and the bottoms. It's different in other markets, but in crypto, that's typically how I like to do it. So I'm much more inclined to just dollar cost average. I don't care if I nail the right price. I don't care if I go all in at the exact dip spot in this particular situation. I don't care if it pulls back in 5-6 months down to even lower prices, because I know that we're in the second inning, maybe even the third inning of a much bigger thing that's going on. That's my personal belief. I could be completely wrong, but that's how I'm playing it. And you got to make your own decisions about where we are in that sense. All right, I think that it is important, if you're not following the way that the futures market is evolving. It's really interesting. If you don't know much about futures, it's worth learning about. But essentially, each one futures contract represents 5 Bitcoin, and so it's a way for a lot of institutions and bigger traders to get exposure to the price action, but the contracts expire each month, so you got to roll them over. So it's not really for people that do long-term holding stuff. So it adds a lot of the efficiency, quote unquote, to the market, which allows for things like these gaps to get filled, allows for the market to really kind of grow in a healthy way. But I would check this out. The Bitcoin volume it's growing on CME, and we're just going to see that continue to evolve. Now that's the micro, right? Like that's the actual price action that's happening right now. That's my interpretation of it. Other people are going to have much more detailed technical analysis. They're going to have different ways of analyzing it. That's just what I'm doing. That's tends to work pretty well when you establish what inning you're in. And that's where the magic is for each and every one of you, is to determine what inning you believe we're in. Now, let's take a step back and apply this to one of the bigger narratives of Bitcoin, one of the many. Excuse me, I apologize for any coughing. And let's talk about how this compares to gold. A lot of people are looking at gold, and they're looking at gold as if it's a fractal. Fractal, for anybody who doesn't know, that just means that a pattern that happened in the past can be applied to a current pattern as a way to forecast the future. I don't love fractals, but I do think that they can be helpful for mental frameworks that can help you frame your decisions better, which is why I think this is a worthwhile exercise. So for anybody who's listening on the podcast, you're not looking at this. Essentially, back in the 70s, gold had a crazy bull run, and then futures kind of hit the critical mass of having enough volume. And lo and behold, it hit a bubble. And for the next, call it 15, 20 years, it really had the same profile as what Bitcoin has had for the last 15 months or so, where it peaked and then it came down to this valley. Now, when you look at this as a comparison to Bitcoin, which I will come back to here, it's obviously not identical, but I would make the case that we're here, right? So we're at this like 480 level in the gold chart, or maybe not that high yet. Like down here, kind of get my face out of the way so you guys can see the prices. Like this 400, kind of at this previous support level, which is similar to what this 6,400 is in Bitcoin. And you can see that there really aren't many pullbacks. It's kind of a straight shot up to, 1921. And if you compare that to the price of gold, 867 to 1900, that's like a 250% gain, right? Let me see if, no, 120% gain. Wow, Sunday morning's really doing it to me today. But you see what I'm saying. So theoretically, if this previous gold peak was the equivalent of 19,000, This next big peak would be like 35,000, give or take. Who knows? Like, just purely based on that. And we are at the beginning of a bull run that's not really going to have a whole lot of pullbacks. That's what the gold chart would tell us. That's what a lot of people are thinking about when it comes to Bitcoin. They're calling it digital gold. They kind of represent similar ideas. I personally have a little bit of an issue with that, which I'll explain in a little bit. But that's another way to look at this in terms of what inning are we in. Again, what inning are you in as a momentum trader, which I believe crypto is really, really good for when it's in a bull run, especially for taxes and getting the big swings and everything. Identifying your inning is the name of the game. If you want a great book on that, go read Reminiscence of a Stock Operator. It's probably the best book ever written on this stuff. And it was written back in like the 30s or something crazy. Another great post, if you ever want to check out my boy Nick, he has a great blog called Of Dollars and Data. And he has this great blog post called Even God Couldn't Beat Dollar Cost Averaging. Great title. He kills the titles. But he has some really good evidence. And he's a data scientist over at in New York at a financial planning spot or wealth management company. And he has some really interesting trends that you can follow. He's like, hey, if you're in a bear market, this is how it performs. If you're in a bull market, this is how it performs. Here's different ways to think about this. Here's if you have a lump sum, if you don't have a lump sum. And he goes through this in a lot of different ways with a lot of different, scenarios in terms of if you have any money. And by the way, this is not like sponsored. He doesn't know I'm doing this. This is purely just because I like his stuff. He writes great content. He's a great guy. I've talked to him a bunch of times. But this is the sort of thing that you can really, it can give you peace of mind. It can give you certainty. And when you have certainty, you're much more likely to make decisions. And when you make decisions, you get action. The things actually happen. It's indecision. It's the analysis. It's the overthinking of stuff that really kills you in investing, in trading, in anything. And so this can help you just make a firm decision, create a plan, create a mental model, create a schedule if you're going to do dollar cost averaging, and then execute on that schedule. And so just to wrap up, just to kind of bring it all home, I'm looking at this. I'm going to wait until it hits these gap areas on futures. That's like the deployment of larger amounts of fiat. And in the meantime, I'm just going to dollar cost average. Let's call it every Monday or something, I'll buy in a certain amount. And I don't really care. I mean, it'd be nice if it pulls back and I get these, but at the same time, it's like, I'm still going to just dollar cost average because I believe that this is in a bull run for the next 2 years. Who knows? But that's what I'm doing. All right. So that's Bitcoin. And I would say that I'm going to spend most of my time talking about Bitcoin because I personally think that that's just like, let's get the best chance of hitting a high number. I think that there are plenty of coins that are going to vastly outperform Bitcoin. There's no question about that. But one thing, I'll talk about this later on, that I've learned is that it's way better to have a higher degree of certainty in something and then get very creative on how you can capitalize on that certainty than it is to have a lower degree of certainty but a much higher potential reward, right? In this case, I would rather have 80% confidence in Bitcoin than 50% confidence in something that could go 50x, because there's just different ways. There's different ways to think about it. There's different ways to deploy capital, different ways to use leverage. And that's something I have learned over the last year or so that I tend to do much better with. I tend to make way more money with high certainty, lower growth than low certainty, high growth. Other people are the exact opposite. That's what makes the market work. Looking at coin market cap, there's not really much to talk about here. I personally think that a lot of this is for the traders out there in the world. I think that the big thing, if you are going to start going into altcoins and other coins, is I think we're getting to a point where you're going to start to see a couple of these coins do really well, and they're going to start to kind of move up and establish themselves as valuable, and their token price or their coin price goes up and maybe even plateaus or whatever it does, but it survives, which I think is really the name of the game. But I think that if you don't have, let's call it 3 to 5 coins that you are you know a lot about, and you have a very, very strong understanding of and case to be made for why it's a win, you're much better off just diversifying into, let's call it the top 10 coins, where you kind of market cap weight them like an ETF, and you ride the top coins, because the chances of success are, the crypto is going to be a power law thing, right? Like the winners are just going to be the ones that win big, more so than anything else. And I think that that's one thing about diversification that I think can be used in this phase of the market, where often you think about diversification as a way to preserve wealth, which that's very true. But I think in a market like this, diversification can also be like, it's like spreading a lot of seeds out in a garden, and then you wait and see which seeds grow the best. And when you do, you go out and you buy more of those seeds, and you plant those seeds more often. Whereas I think a lot of people try to predict it before they even see the progress. And if nothing else, I can tell you that the biggest thing I've learned trading futures, investing in crypto, is that the trend is your friend, and it is way better to double down on winners than to try to double down on losers. I can't stress that enough. It sounds like you're kind of wasting your money by doing that, but it's actually the exact best way to kill it in trend markets like this. And so when you diversify early like that, it gives you a sense of which ones have the momentum. You can start to pile into the winners. And chances are, once it's going up, it's going to keep going up. That tends to be what happens in markets. And then you can adjust as it goes parabolic and things like that. So if nothing else, I would say find 3 coins, find 5 coins, find 1 coin, find anything that you are very bullish on, and have your own reasons, but be able to have like serious conviction of it. And a really good litmus test for that is if you see a coin, like you're hoping that it drops in price, and be really honest with yourself about that you want it to drop in price so that you can buy a lot more. That is a very, very good indication of that you truly are bullish on it, and you're not just like selling yourself on, hey, I want to be bullish on something. So that's what I would say. I do think that there's going to be more winners than the average person thinks. I do think that it's not going to be like 99% of things go to zero. I actually think that there's a lot of potential stuff that could do really well here. I just think it comes down to a relative choice. And I think Bitcoin's, I'm very, very high confidence that it's going to go past 20,000 again, or for the first time, I should say. And that's all I care about. That, like, full stop, end of conversation. Great. Let's figure out how to maximize that high certainty trade, period. And I don't spend a lot of time trying to find some moonshot thing. So let's talk about a little bit of a transition outside of the price action world, outside of the crypto world. Sorry, I don't know why my throat, maybe it's, I just like haven't done these videos. So I'm not used to jamming on this Banana Town stuff all the time. There's a lot of new conversation coming out, a lot of new companies. Fidelity's coming out with cryptocurrency trading. I believe E-Trade is. Robinhood obviously already is. Square, you can buy it. And this is getting a lot of good publicity. TradeStation actually is one of the big trading houses coming out with it, brokerages, I should say. And then you'll start to see other assets like Ethereum. I'm sure will have it. And what's interesting about this is that it definitely increases adoption. But for the real price moves, right? For the long-term wins, this stuff is helpful and it's important because this paves the road for ETFs. But at the end of the day, what really matters is how many people hold on to their crypto, specifically onto Bitcoin, but really anything. The network needs to be valuable in the sense that it needs to have high demand. People need to use the network. People need to build applications on top of Ethereum or whatever platform, protocol they're building on. People need to own Bitcoin for the scarcity model to actually work. And so while the trading is very helpful, but make sure you recognize what the benefit really is. More traders does not mean price goes up. In fact, usually more traders means the price stabilizes and or goes down. But this can help pave the road for something like an ETF, which will then get more holders. So when you're thinking about this news and you're seeing it, step back and ask yourself, the price will go up the more people that buy it and hold on to it. Does this help that happen? If the answer is yes, great. Be bullish on it. If the answer is no, dig a little deeper. Find out, how could that happen, right? Like, what's in it for them? Fidelity is going to make a lot of money. Fidelity would not allow crypto to happen if Fidelity was not going to make a ton of money. So there has to be a bigger reason in order for Bitcoin holders to make money as well. It's always helpful to keep in mind. Again, I mean, I remember talking about this back in 2017. Some people don't like it. The best thing people can do for Bitcoin and for crypto, if you want the price to go up, is to go get 5 people in your friends and family and get them to buy $100 worth and just to hold on to it. That is by far the best thing that can happen for the price, because it just makes the network stronger. It makes the scarcity increase. That's the name of the game. And that's what drove the huge run in price back in the day, in 2017. It also drove the big alt season, is that there's way more people coming into the system. I do not have the same insights into how many new people are buying crypto right now. And that's the case for this Fidelity, is that people that didn't have access to it will finally buy it. I personally don't know how true that is. Until there's an ETF, I think that a lot of people would just go to Coinbase. Hopefully I'm completely wrong on that. But I also think that that's why a lot of these altcoins are going to have a hard time until they're proven, until they have a very strong use case, because a lot of the new money that comes in will not be the same mindset as what came in 2017. Doesn't immediately go to Binance or any of these smaller exchanges to buy the cheapest coin to try to get the maximum return. Of course, that's going to happen from time to time. I think it's a different beast than it was. So keep that in mind. So I think that's really, I'm watching this very closely, mostly because when last time this happened with CME, it was a very rude awakening in that sense. And I think that this will not affect price as much, but it could be a false alarm. But it could also lead into the opening of an ETF, which would lead to more holders, which would then drive the price way up. And I know that in some level, it may, especially for anyone who really believes in the vision and the idea of Bitcoin, that kind of financial massaging of just being like, let's just remove supply. It's kind of like buybacks. By doing that, you're kind of artificially driving the price up. That may feel a little weird, or even you don't like the sound of that, but that's the name of the game. That's supply and demand. That's how it works. And that's part of the appeal of Bitcoin as a price asset, is the fact that there is a fixed supply. That's a very, very, very big deal. And when you're thinking about price, supply and demand, that's it. That's like the thing. So I think you have to at least volunteer that is probably a very important lens to look at it through. Okay. Now, here's the other thing that I'm really thinking about a lot. And by no means is this an endorsement of any coins. Like, I'm not saying that any of these coins are going to do well. But I was talking to a hedge fund manager, I don't know, maybe 4 months ago, 5 months ago. And I was talking about, hey, what's it going to take for a hedge fund, or more importantly, a sovereign fund, which is like a government-backed, slush fund, really, to a certain extent. If you want a great book, check out, Billion Dollar Whale. I just listened to an audiobook. It's ridiculous about the whole Malaysia Goldman Sachs thing. It'll make you really trust the global financial markets. It's a joke. But what he said, I asked him, I was like, what's really the issue? Like, what are people missing that big investors are thinking about that most people on like the price action level are not thinking about? And he said something really interesting. He's like, the problem with crypto right now is that there's no yield. And so the entire thing is based on capital gains. So what that means is that when you look at Bitcoin, the way you would make money as an investment on Bitcoin is for the price to go up. There's no interest rate. There's no dividend. There's no kickback. Not kickback's the wrong word, but there's no reward for holding on to it other than just the price going up. And now, obviously, that's why price can go up in a huge way. But it also, when you're managing, let's say, $10 billion, that's a very hard thing to do because you can't trade an enormous amount of money. You want to be able to buy something and hold on to it for years at a time, if not decades at a time. And the yields, like the dividend or the amount that you're making by owning that asset, plays a huge part into your forecasted returns, into your diversification portfolio, into your risk management strategy. And so when you look at most of these cryptocurrencies, many of them don't have that built in. However, you're starting to see more of them say that this is something that they will offer. And at first I had a problem with that. I was like, what? This is BS, right? Like proof of stake and being able to getting paid for that and masternodes and all that. I was like, what is going on? But the more I think about it and the more I learn about other markets, the more I realize like that's actually how everything works. You should be rewarded for holding on to something. You're taking a risk. Like the asset or the asset owner should make a very concerted effort to reward you for taking that risk. And I think that that's not going to change. That mindset will not change. And that demand for that sort of risk aversion will not change either. And that's why I think, this blog post came out on March 29th for Coinbase. This is like I said, not endorsing Coinbase. I'm not endorsing Tezos or Maker or anything. But they're incorporating Tezos into their Coinbase custody product, which is an institutional product. They've raised like, I don't know, 500, 600 million for it. In order to get a yield that spits out, in order to at least match inflation, which in the US at least, they're targeting 2%. We're going to talk about inflation a little bit. So think about that. They have this kind of basket of crypto, this index fund. There must have been some serious pressure from other institutional people, from hedge fund managers, from funds, from sovereign funds, from family offices, whoever, that said, we need to have some level of baseline inflation protection. And then we also want to be able to get some sort of yield off of this. Right? There's a lot of risk that goes into that. Coinbase obviously, this is obviously something that they are getting the conversation of. Otherwise, they would not have written this blog post. They would not have made this offer through this lens where they're saying, look, we are now going to offer a percentage dividend yield on anyone who stores money in our custody accounts. This isn't even like a growth fund. This is just like a bank account, right? It's like a what do you call it? The money market account, right? If you have one of those and it basically just pays you out whatever the federal funds rate is. It's the same idea. And so we're starting to see crypto, we're starting to see the assets of crypto parallel the existing frameworks of the global financial markets. We're starting to see it look like those options. You could finally compare it apples to apples in the way that these big institutions need it to be laid out. So I think that's really interesting. And so when you're doing your research, when you're investigating into your coins, it's starting to be more like the stock market, where, and like stock market like 30 years ago, when dividend investing and dividend reinvestment plans and all these, that was a big deal. And the big reason for the S&P 500 for the compounding growth to go through the roof is because you get that yield, because you get that, was it like 1.8% a year right now, gets reinvested back into your holdings, and it grows and grows on top of the capital gains, and it makes a huge difference. Right? That was a big deal. Nowadays, dividends in the stock market are getting just completely decimated, mostly because of buybacks. And people realize that having capital gains on their stock price is much more appealing and much more effective than it is to pay out the profits in form of dividends to actual shareholders or employees or whoever, equity holders, I should say. And so I think that there's a huge void right now for owning stuff that spits off a yield. I think that when you look at the global market, you look at what possibly can. You're looking at bonds, which I think government bonds are kind of crazy to say, but I think it's going to be kind of a risky play in the next 10 years, which is insane, right? Like, who knows what that means? You look at stocks, which I think the overall SEC yield on the stock market is going to continue to drop, meaning that all the money is going to try to go into capital gains if they can make that work with buybacks and everything else. And then you look at things like commodities, which you can often get a much higher yield on things that like oil or natural gas or things that have like very long-term time horizons, so they can afford to kick out a dividend for people to hold on to it. But the options are shrinking and the yield numbers are shrinking. And so all of this is a way to just define risk for people with a lot of money. And I think that risk is going to move into stuff that can kick out a dividend. And I think that crypto is going to slowly start to offer dividends in a way that the rest of the world, the other 145 tradable assets out there, are failing to do for the big money. And if crypto can make this work, essentially by securing a network, like that's what you get paid to do, it's going to be very, very good, both as investments and as you make your narrative decisions. I found this website. I have no idea who these guys are. I think they're in San Francisco, but it's called staked.us. And they have just like an ongoing list of different coins that have staking and yield producing, compounding stuff, right? So if you buy like Tezos, LivePeer, Decred, Dash, Cosmos, the list goes on. It shows you in kind of a one-stop shop what you can make from a dividend. Now, obviously, there's still a lot of risk involved, because if the price goes way down, like, who cares what you're making on the yield? You just got smoked on the dividend. The other big piece is that the ones that have the best yield, right, that are giving out the best dividends, you have to lock it up for like a year. Like Loom, for example, you can get 20%, but you have to lock up your tokens for 12 months. So you start to weigh yourself, like, who is that really good for? Well, it's good for someone who has an enormous amount of money, and like they couldn't move their money anyway. And this is an interesting way to manage their risk, assuming they have a very good thesis on the product working. This is nothing about Loom. I don't really know much about Loom. Same with lending. It's kind of, there's plenty of kind of these derivative platforms that are lending out crypto. Like, this is nothing new. This is how margin works in a lot of brokerage accounts, where you can just kind of lend out your coins at this sense for people that want to trade or people who want to lock it up, and you can get paid for doing that. You don't have liquidity. This is the premium you get for your liquidity. So anyway, this is just a cool way of doing it. They do offer, like, you can stake to like, you don't have to set up your own staking mechanism. The problem is that they charge a pretty good amount of money from what I could tell. So, buyer beware. Now, last thing, second to last thing I should say, is how is this whole Bitcoin thing, what's the story? Like, what is going to get this thing to do what gold did? Gold's story over the years really was like, it's a hedge against the government, it's a hedge against inflation, it's a hedge against the world collapsing, it's a scarce asset, it's been around for 5,000 years or whatever the number is. And that really drove this huge bubble between the 2000s and up to 2011. Now, what happened in 2000? Well, March 2000 is when the NASDAQ bubble dropped. 2001 is when S&P basically went into a recession. I mean, this is kind of give or take 6 months on either bookend of here. But there was a lot of uncertainty. We had September 11th in 2001. There was just a lot going on where this distrust and this kind of fear was building. I mean, anyone who remembers, if you were around back then, it was just like foreign policy and threat of what's going on in like the Afghanistan and all the war and it was real. I mean, that's what we saw on the news each day, versus now where it's all about, we see about the finance and about the actual political kind of power struggle. And you're seeing a very different world. And so obviously gold did really well in the sense that it was at a low point after this peak. And so it also had a very good narrative. It's like, look, the world could easily collapse at any point here. China's going to take over the world. We're all screwed. Buy gold. It's your best bet. And it did really, really well. But now gold is having a very hard time maintaining that narrative because it didn't really like, it's so financialized, and also just it's harder for a younger generation to get their minds around gold, in my opinion. It's also it hasn't performed well, right? And the best reason for things to keep going up is because it went up yesterday. Like, that's higher prices get more people to buy. Then you look at Bitcoin and you start to say, like, okay, well, there's a lot of similarities here. The difference, in my opinion, is 21 million versus a false scarce asset, right? Like, I started watching this show, was it Gold Rush on Discovery, because I wanted to learn more about how the gold mining process worked. I want to learn more about gold as an asset. And what you realize is that there's billions of dollars of gold being mined every single year. And I don't see that ever stopping. I think they're just going to keep finding more and more gold. I mean, maybe I'm wrong, but I don't see that ever slowing down. I think they're just going to, oh, hey, we just found this $1 trillion reserve in Africa or something. Like, that's just always going to keep happening. Whereas with Bitcoin, there is a mathematical finite, like, this is it. Like, the number stops here. And like I said before, with power laws, as long as Bitcoin stays in the lead and the alternatives don't become as big as Bitcoin, that 21 million is a very, very big deal. And so when you're thinking about inflation, you start to think about, okay, well, how does that really manifest itself if gold is not doing what people want it to do, which is hedge against inflation, which, I mean, it does kind of, but it's not like a very good hedge, I guess, as it should be. How does that compare to something like Bitcoin? I put together this little thing, which I'm going to pull up my kind of textbook, these like funny things I make. I like doing these. For anybody listening, this is like a little PowerPoint. And what I think is really important, I did a lot of research on inflation. And I should preface this. The reason I'm talking about inflation, I personally think inflation is going to be a big deal in the next 2 years, maybe 3 years. I think there's a lot of people who are talking about, the US dollar is going to kind of just take down everything, which it can do. And I'll talk about that in a second, which is most like, if the markets were left to their own devices, that's probably what would happen sooner rather than later. And the debt crisis would just go through. It would be a disaster. But we don't live in a free market. We live in a political world. And that's a really important point. The other piece of all this is that I think inflation is misunderstood. I think I very much misunderstood this. And the reason why is that there's 3 kinds of inflation. Okay? The first kind is demand inflation. This is what it is every year when prices go up. So when people want more things, when people want more stuff, the price tends to go up, right? The demand exceeds the supply, hopefully at a healthy rate, right? The whole point is that you keep it at 2%, you keep inflation at 2%. That's very good proxy for demand inflation, in that it continues to push prices up even with a constant supply. So if people consistently keep buying avocados and we keep having more people in the world, and the growth is just going to come with it, because we're going to have to produce more avocados to maintain that demand. If you stop producing avocados, there's a shortage in avocados, you're going to get big spikes in that, which we'll talk about in a second. So as long as people keep wanting stuff, the prices will usually match it. Now, avocados are obviously a commodity. There's a bit of a supply fluctuation, but it's a farmed commodity versus something like everybody wants a TV, but technology can dramatically change the prices on that. So it's a little bit harder when you come to technological based demand until it's kind of commoditized, right? Innovation can't drop the price. So the first thing is demand inflation. This is what the Fed targets. So when you talk about the Federal Reserve in the United States, there are 2 mandates, basically hit the target inflation rate, 2%, and keep unemployment down as much as you possibly can. Right? QE, quantitative tightening, quantitative easing, that's a little bit more of a gray area. They're mandates though, inflation and unemployment. And it's mostly behind demand side inflation, which is what the CPI is, the Consumer Price Index. That's one of the big ways that they make their decisions on interest rates, which affects the money supply, things like that. Second type of inflation, which is what most people like to write headlines about, is currency inflation. This is what you see in Venezuela, you saw in Argentina, you continue to see in Argentina. This is when you really start to get a lot of people hating on the central banks, which for good reason. I'm by no means am I taking a central banking side here. But when this happens, this comes down to like an economy is not doing well. And so they need to depreciate their currency in order to make it less attractive to own that currency in order to make exports much more attractive, right? If your currency is very cheap, you are going to be able to export a lot more stuff because your stuff is going to be a lot cheaper relative to the rest of the world. If your currency is very expensive, it's going to be very hard to export stuff because it's going to be expensive relative to the rest of the world. So in theory, like the economic theory is that, hey, if we need to really stimulate the economy, we need to use the Fed, or we need to get this currency cheaper so that we can push more stuff out, right? ISLM curve, more exports equals more growth. That's kind of a separate discussion. But this is one that gets all the headlines, is that because this is the one that can be manipulated. And this is the one that often leads to hyperinflation. This is like, it can kind of go off the rails very quickly because we don't live in an isolated world. Other countries can speculate on it. Debt plays a big part of this. Things are pegged, things are floating. It's all connected in certain ways. So you got to watch that as well. What does this mean? It means that demand inflation can drop, currency inflation can go up. People can want less stuff, so you get demand deflation, but the dollar can be worth less, so you get an inflation. That's called stagflation. That's like growth is basically dropping, but inflation through the dollar is going up. So you see how there's like a lot of different ways you look at this. And then the third one is the asset inflation. This is what we're seeing with assets like equities, right? So the stock market, things like artwork is a good one. You can make a case for like cars, sneakers, right? I mean, I posted something about sneakers on Twitter a while back. But this is when you take an asset and you start to look around and you say, okay, what tricks can we use? Maybe not tricks, but what techniques can we use? What strategies can we implement to make this asset go up in price? Really good example of this is buybacks, right? I understand the argument for buybacks. I get that there is no better use of capital if your mandate as a company is to get profits to your shareholders. Buybacks are the best way to use your money. There's no question about that. Is it morally and ethically the best thing you could be doing? I think that's where it becomes a gray area, but who am I? I play the cards as I'm dealt. But these are the things that people use in order to make assets look like they're worth more and more and more. It's the same way that you can securitize assets and make ETFs back in 1982, or collateralize bonds and be able to sell new products to make the stock market go up. Same thing that happened with the housing crisis or the housing bubble back in 2005, 2007. They started wrapping up they created these new products that created just new ways to make money, right? And it drove asset prices up and up and up in everything. And we're starting to see that in equities as well. I don't know if this is as like a peak of it. I don't know if we could easily just continue to scream through up to like 3,300 on the S&P 500. But this is a different kind of inflation. You can see that it can be related to the other two, but it's its own beast. If you can manipulate the price of an asset just by working how the asset is in a marketplace, like the float of the shares, maybe you hype the hell out of it. A very crude example is if you had blockchain to your, the name of your stock in 2017, it would go up 80%. Like that's asset inflation. And that's the sort of thing that's rampant right now is out here in Silicon Valley, this is the name of the game. Like, how do you raise, like, who do you get your rounds from? Who do you raise capital from in order to make the company more valuable on paper? And it's more valuable on paper because the person who raised money after you put in more at a lower price, or, at a lower valuation for a smaller percentage of it. And so magically the company's now worth twice as much. That is asset inflation. And that's everywhere. And so the reason why all of these, it's important to differentiate all these, is when you're hearing about inflation over the next 6 months, 12 months, whatever, you got to ask yourself, which kind of inflation am I hearing about? Is this because people will just want more stuff, which is healthy? That's growth. That's like what always happens. People are consumers in this world. Is it because of currency inflation, which I think is probably the one that impacts Bitcoin the most, because it will, like, the world is based on debt now. And it's the most, like, the US dollar is probably the most important thing in the global financial world. It's the most important, like, single price, like that, because that dictates everything in terms of debt. And that's the world we live in, right? Because of the whole last 10 years. But I think this is one you want to watch, is how does currency inflation happen, and how do people hedge themselves against currency inflation dropping? I do not think that demand inflation has anything to do with Bitcoin pricing. I don't really think asset inflation does, other than more like a fear index. But I do think that as currencies start to switch, and as currencies stop getting propped up and the free market starts to take over via debt repayments, you're going to start to see this really make a big impact. So what I think is going to happen, which again is just a forecast, just a guess, I think that demand inflation is going to start to creep up through the CPI. I think that you're going to see this start to go like 2.2, 2.3% in the US. I think that the Fed is going to say, okay, we need to rethink our inflation, but we're still going to watch this closely because blah, blah, blah. And then it's going to start ramping really quickly, because these other parts of inflation, currency inflation, the asset inflation, are going to trickle into that CPI number, and you're going to see it spike. And all of a sudden, the Fed's going to be like, well, our mandate is unemployment and inflation. We need to raise rates. It's going to jack the dollar up, and then you're going to have a huge problem globally. I don't know if there's going to be like a big crisis or whatever's going to happen. All I know is that I think that series of events is going to make people think very, very seriously about owning some Bitcoin, because it's one of the only things in the world, if not the only thing in the world, that is truly like independent of these first two. The last one, obviously, it's like the poster child for asset inflation right now. Like it just gets hyped up and the thing goes through the roof. But like by thinking that way, you can really start to think about how you're going to hedge yourself, how you're going to beat inflation. And I'm not talking about like in theory. This is like a thing. This is not just about, hey, I want to make money in crypto, which I think is obviously an amazing byproduct of being a part of this. But I think you want to start thinking like an investor. You want to start thinking about like a macro investor, where, hey, if I know inflation's probably going to happen, because it's the only way that the US dollar just doesn't break down everything, how do I hedge my assets? How do I hedge myself against that? Now, typically it's like commodities, gold, oil, metals, things that are relatively fixed supply. Housing, loosely speaking, Treasury inflation protected securities, which is essentially just like a tranche of long-term bonds, like 30-year bonds they put together. The yield typically beats inflation, which you can see how that would work if they raise rates. Like the yield is going to go up, but the price is going to go way down. So tips get, it's harder to do when there's volatility in bonds. But none of these are like real bets against a global inflation issue. Whereas I think Bitcoin is, right? Because I think that some of these could work better than others, right? But equities have always beaten inflation too. But who's to say it's because equities just haven't massively done asset inflation, right? To just continue to outperform inflation over the short term. When I say short term, I mean like the last 10 years. So this is the big thing that I am thinking about. Okay, this is the big idea when I wake up and I think about what does the world look like in 2 years from now from an investment standpoint? How can I start thinking about this so that when I start to see the signs showing, when I see inning 1 happens and I know the next 9 innings are coming up, I can have a plan for inning 2. My bet is that there's going to be a lot of inflation. I do not know where it's going to happen. I don't know if it's going to be demand inflation, currency inflation, or asset inflation. But I do know that no matter what happens, Bitcoin is going to have probably the best bet at hedging against all 3 of these than any other asset I've seen. And I think that that is a very, very big deal. And I think that is because of this that we will see a lot of really big growth in the next 2 years, because inflation is going to be a very new concept. We haven't had really major inflation in the United States, globally really, in the last 35 years. It's been essentially flat. I mean, there's like a little bit of volatility, and people are like, oh, maybe inflation is dead. Like maybe we'll never have inflation again. Maybe we'll never have recession again. I think that that's completely short-sighted. And so I think that that is a very important reason. And so when you take it all full circle, right, you take all this information, this is like where I'm coming from. This is what I think about. You see these outside worlds coming in. You see Bitcoin price action moving up. You start to put together the pieces and you start to think a little bit bigger about what this all means. And what this really all comes down to is why you should think about Bitcoin as part of a bigger strategy for yourself, and less about, am I going to buy in the dip at the exact right time and then scalp it and make money? I'm not trying to downplay anybody that's looking to make income off of trading. I think that that's an amazing thing. And I hope that you do make a lot of money thinking about that. But I also think that the big money is made when you start thinking about these big ideas, and you can position yourself so you can make your everyday decisions, not make or break. It's not about, do I go all in at this particular price? It's much more about, how does this fit into a 5-year window? Because you're going to make way more. You're not only going to make money on the upside of Bitcoin, you're going to protect yourself from potential downside and other things. Again, I could be completely wrong on all of this. This is just this is how I'm looking at it, and this is the reason, the pitch I have for Bitcoin, for myself and for my friends, like for you guys, right? For anybody who's listening. So that's where we're at, right? That's the way I'm looking at this. I think that the big risks for Bitcoin is that we've never seen what happens with Bitcoin in an asset inflation bubble burst, right? The genesis was 11 years ago, 10 years ago now, 10 and a half years ago. And arguably that was like the biggest asset inflation bubble in history. And so Bitcoin's obviously, like I said, the poster child for asset inflation. What happens when other assets start to show cracks in their inflation, right? They run out of ability to buy back, or this law gets passed that they can't do buybacks anymore, which could happen if someone else gets elected to be president. So like, we don't know what happens when other assets don't inflate anymore to Bitcoin. But I do think that the other sides of inflation, the currency and potentially demand inflation, will be so out of whack that Bitcoin will continue to do well. I think that it may go up to something like 30,000, 35,000, and then have like a blow off and then kind of a consolidation, similar to what gold has done, right? Like you can see it here in this sense. And then you're going to get into like the big questions of, is it a legitimate asset? What other currencies came out? How big of a deal is this yield thing? What's the supply look like? Who owns it? Is it sovereign companies owning it? Is there, a big pushback against it? Who knows? But I think that's a very good pitch. That's a very good piece of the puzzle for Bitcoin. Now, last thing, things I've learned. I thought that this would be interesting, not because I'm like trying to talk about what I do. I'm not like trying to say, hey, here's what I did, blah, blah, blah. I think it's just helpful for people to understand why I stopped doing videos, where I'm at right now, and like what I've done for the last 9 months, because often, for whatever reason. First thing I've learned, so I stopped doing videos last June I think. And I was starting to do them like once a week. It was like June of 2018. And it had something to do with price because like, more importantly, I was making videos. One, I didn't really have anything to talk about, which is the big reason. Two, I was spending a lot of my time trying to convince people that Bitcoin is still interesting, the crypto is still interesting, that global finance is still interesting. And let me be clear, there's so many of you that reached out and were like, oh, thanks, this was awesome, please come back, whatever. So I'm not saying this is everyone, but the amount of negative emails I was getting, or negative comments I was getting, the amount of people that were trying to scam followers, the amount of people that were trying to hack different stuff, impersonations, it was just like I was spending all my time trying to make myself feel better about doing another video. And if you've never read this book, The Subtle Art of Not Giving a F, it's awesome. If you don't want to read the whole book, go read his blog post, same title. I read this a few years ago, and it was one of the best books I've ever read because it really makes you realize that the key to life is being able to choose what it is you care about, what it is you want to give your energy and your attitude towards. And I think when I graduated college, like I didn't have any money. I slept on the floor of my brother's dining room for 6 months. I was a landscaper. And I'm not trying to say that I was like broke or, anything like that, but I didn't have any money. And I understand what it feels like when you feel like you don't have an option of what you can choose. So I'm very sympathetic to that, to anybody listening that's like, oh, first world problems, bro. But I do think that no matter where you are in your life, like you do get a choice of, do I want to focus on all this negative energy that's coming my way right now? Or do I want to focus on something maybe a little bit more interesting, a little bit more something that I could grow and I could be excited about, that doesn't come with all this baggage that Bitcoin had. And so I just woke up one day and I was like, I can't keep doing this. And if I go up and make a big thing about it, if I make a big video about it, it's just going to add to more negativity that I got to deal with. And that was like a huge thing. And that's like a huge theme of the last 9, 12, 10 months, is realizing that you can choose every single day what it is that you want to care about. And even if you're in a situation where there's a lot of stress or you're having a hard time, obviously every situation is different. But as soon as you take ownership and be like, I can choose what it is that I'm going to focus on today, even if it's like the smallest thing, like a cup of coffee or not having a cup of coffee or whatever, it gives you a huge change of energy and it allows you to really grow and like do new things. And so I just made that decision that I really wanted to focus on new things and kind of create a new path in a way that the energy would start to fuel me. There's one of the best articles ever written by Ben Stein, 2006. And it's called The Economics of Love. You should Google it. He's like a very, very dry humor guy who talks about, he kind of lists off how you should be with or choose a partner based on like the most boring investment advice ever. And one of the things was like, if you're not getting an ROI from your investment, like you should sell immediately. And that's kind of where it was at. Like from an energy standpoint, you gotta go where you're getting energy back, and you just gotta cut your ties and do that if you want to keep growing in life. So anyway, that's that. More importantly, what I did after that is many of you, or some of you who follow me on Twitter may have seen this like Twitter thing I did all about how I'm gonna learn how to become a really good trader, and how everyone's like, everyone who trades fails, and it's the most impossible thing in the world. And I always think that that's hilarious when people tell you that, how competitive or how hard something is, because you're just like, the fact that everybody's saying that is a really good sign that there's a lot of people that are going to quit. So I learned a lot about the futures market with not trading Bitcoin or anything, but trading pretty much everything else you can imagine, and learning how the whole thing works and getting really immersed in it. I spent about the first 5 months just understanding how things worked, like how to read charts, how actual contract structures work, how rollovers work, how it all happens, how the leverage works, which is a huge thing in futures. But what I really found is that it's really hard, it's really fun, and trading is directly correlated to the quality of people and information you are consuming. I found that when I started trading futures, I was unfollowing so many people on all these social networks. I stopped using Facebook. I started unfollowing people on Instagram, started unfollowing people on Twitter. I was just like, what have I been like putting in my head? Because when you get into something like futures, you realize how competitive it really is. And if you don't have some level of an edge or a clear head, you're just going to get completely destroyed. I mean, like not even close. And so you got to be able to pull in information from all these different places, process it, and then apply it to like the last bastion of competitive arena out there. But if you get that good information and you surround yourself with really smart people, and not like, I know a lot of people like aren't in a position where you can be around physically a lot of people all the time, but listen to really smart, really technical or really good people like on their podcasts. Go on Twitter, find them, like people that are typically a lot older than you or a lot more experienced than you, and learn from them, help them out, right? Absorb their information. But it makes all the difference when you're going into a competitive space. And what I learned is also crypto is unbelievable. I mean, it's like the most amazing trading environment ever created. But I also learned that it's really good for certain people's styles. But I tend to work really well for momentum in crypto, and I work really well in high liquidity environments, which is what future provides. And so when you start to break down what works for you, and then you can really surround yourself with those people. So that's been an awesome experience, really fun experience, and a profitable experience, which is kind of a great trifecta. Third, I cannot tell you how much better life gets when you start prioritizing your sleep. This may be the most played out, cliched thing, boring thing, whatever. But I think I can't believe how little we are spending, how little we are prioritizing really good quality sleep. Look, I know how hard it is to get good quality sleep. If you're in crypto, if you have young children, it's like good luck getting any sleep. If you've got like a sleeping disorder, I understand it's hard, but I also think that there's a lot that people can do, myself included, to get really high quality sleep. And by getting really high quality sleep, it's unbelievable how much other things in life change. Like it is the domino that unlocks everything. And it takes weeks, sometimes months of getting good quality sleep for all these like mental, physical, emotional, like everything starts to really kind of come back to a place of homeostasis and feeling just way more kind of clear-headed, balanced, on top of things. And I think that I underestimated how much was required to get a good night's sleep. And so one of the things I've been spending my time on is like, okay, if I structured my entire day around getting a good night's sleep, what would it look like? And I've done that, and it's been unbelievable. And I've obviously slipped up some weeks and done better some weeks, but that's something that I've really, really put a lot of time and effort into, because the benefits are huge, but more importantly, the risks of not getting good sleep are so crazy. Like it's insane. If you want to listen to some amazing podcasts, go to Peter Attia, Attia. He just interviewed 3-part series with this guy, Matt. Can't remember his last name. Is a sleep specialist. Blow your mind. But that's one of like 50 really high quality studies or conversations I've heard. So prioritizing sleep. It sounds stupid. It sounds boring. it's the best investment I've made of my time, like in a very long time. Second to last thing, global markets. I've started to learn a lot about global markets. So at the end of the kind of first season of Coin Mastery, I was starting to get into how global macro starts to play in. I've learned so much more about this stuff than I ever thought, for better or for worse. And I think it's very easy to go into the rabbit hole. It's also easy to just get high on your own supply. You meet a lot of people that are just drinking the Kool-Aid of what they want to happen, and not necessarily looking at what's probably going to happen based on like data or whatever else. Probably, that's the wrong word, but there's a lot of people that are just, they have a narrative and they want it to happen so bad, but so you got to kind of peel apart the layers from that. The big things I've come away with is that macro investing, macro thinking is really good for big bets, but it's very hard to time. So for example, the amount of people that are like, the global economy is going to fall apart because the debt crisis is going to be this huge implosion, and they're like going mega short on the stock market, or they're going like heavy short on corporate bonds or whatever it may be. I mean, it's just like there's millions of people seemingly doing this, and they're probably going to be right at some point. The problem is they're going to lose all their money before they're actually right. But if they do time it right, if they time any of these huge macro bets correctly, with the euro failing, or the Australia real estate crisis, Canada's real estate crisis, Hong Kong dollar peg, like all of these things that could go, probably will go in a massive waterfall. The problem is it's very, very, very difficult to time it. And there's such big moves that the timing is everything. Otherwise, you just get eaten alive. On the flip side, the charts, learning technicals, especially on the futures market where there's like major liquidity, so the structure is way formalized versus crypto. You can't necessarily do big bets just based on charts. You need to know like what's going on for a big bet, but you can make smaller bets that are based on chart structures on a much smaller time frame that have a pretty high, or have a higher probability to give you an edge, right? So if you wanted to bet on certain chart structures, like I like to buy certain dips with volume profiles on the futures markets, there's a certain probability assigned to that you can repeat over and over with a small bet and just start stacking, certain amounts of money. I don't think you could ever push all your chips in on a chart only 15 minute chart structure, unless you're just a complete psycho. And so you need to have the macro for the big bets, but the timing's hard. And you need the charts for the smaller bets, but very good on timing. And then the goal is to combine these two, and that's when you get your maximum edge, right? Edge is really everything, which we'll talk about in a second. And when you can combine these two, that's when you start to look at the world as a trader, as an investor, but you really just look at it as like everything is just this huge, it's just this thing, this organism that's keep moving, and flows are going this way, and money's moving this way, and energy's moving this way, and stories, and you start to just see the bigger picture. And so you can start to make better short-term trades, but you can start to use bigger bets because you understand the context that it's in. And similarly, you can start to see the context that things are happening in, but you can understand if the charts are saying that that there's a higher probability of that happening soon or not. And so putting those together has really been, that's what I spend most of my time doing, is just aggregating the information, parsing it down, taking crazy notes on it all, and then trying to break it into digestible pieces without getting overwhelmed, all the way down to like actionable stuff. Like, what can I do about that this week? Many times there's nothing I can do about it. Sometimes there is. But it's been a phenomenal, really fun education, I should say. Last, I posted about this on Twitter. Anybody who's been following this channel knows that this is like the thing that's probably changed my life more than anything. Speaking of edge, if you ever want to learn, if you ever want to understand why people in trading and investing are always talking about, well, you just got to have an edge. When you start to get into the markets, you realize that you need to have one thing, something that puts you above a 49% win rate, above a 50% win rate, really, give or take, risk management. But you need to have that little thing, because then you can apply it to very liquid or very big opportunities and just start shaving off a little bit here, a little bit there. And the better your edge is, the higher your probability is, the more you can consistently pull in. And trading, obviously, the idea is you can more consistently trade in profits, but it's true in anything, right? So like if anyone's listening on the podcast, this is that slight edge where it's a compounding exponential curve up, a compounding exponential curve down. And it's all about making small decisions that really grow exponentially over time, and making small decisions that grow exponentially downward over time, like things that are easy not to do. Like it's easy to eat like fruit or vegetables in the morning. It's also easy not to. It's easy to eat that like sugary cereal. Like it's stuff like that, where the more you just do these things that give you a little bit of edge in life, over time, the more you reap the big rewards. And so I've spent a lot of my time thinking about this, specifically through the lens of trading, through macro, through investing, through all this sort of thing, in order to get an edge as fast as I can, is like without getting greedy about it, in order to be able to increase the amount that I can harvest from opportunities as they come. One of the things, like, I don't know if I ever said it, one of the reasons I got into this trading thing is because somebody told me once, like 2016 or 2017, they messaged me and said, hey, you should go buy some orange juice futures. Like this Florida hurricane is going to destroy the crops. And I had no idea how I would possibly ever do that. I was like, I have no idea what futures are. I don't know how to buy any futures. I certainly don't have any access to futures. But that always like bothered me, that somebody could tell me something with very good information, and I wasn't able to do anything about it. And what I've really learned is that now there is almost like virtually anything anybody can tell me about change in the world, I can then go and I have a very good chance of being able to make an informed action about that and have an edge in that marketplace to make a trade. And that's really what I've been focusing on, is that idea of constantly honing that edge, whether it be in trading, whether it be in investing, whether it be in your relationships, whether it be in your health, whether it be in your sleep, anything. But you need to have an edge, that because you're going to do it consistently, and then you need to make that edge better and better and better and better and better. And the more you do that, the better. And the reason why I think this is important, for anybody who doesn't know, probably like a lot of people, I built a lot of companies. A lot of them were based on opportunities in markets. I was very early in a lot of different markets, like in Google search stuff, in the App Store, in like to a certain extent Amazon, to a certain extent Facebook ads, crypto, like online casinos, like a lot of different businesses. But what I'm seeing now is like the proliferation of all these new technologies and the way social networks work. It's a lot harder to not only capitalize really early on big opportunities, but it's also like it's not a sustainable business model. You need to be able to do stuff over the longer term, like now more than ever, because the opportunities, the early adopter opportunities, are just getting arbitraged away. And private markets are next. Like they're going to get worked, like all that early access to deals and stuff, that's going to get arbitraged out at some point too. And so when you really look at a free market, like a true marketplace of the entire world, freedom of information, I don't know if we'll ever get there completely, but I think we're heading that way. Having an edge, being good at something is the name of the game moving forward. That is what it's all about, is being able to be better than 50% win rate and working on that, and being able to work on opportunities that come your way and able to capitalize on them. And so that's something that I never really did consciously. I was always just like, I would learn a ton of stuff, I would execute on it, I would capitalize on it, and I'd be like, okay, well, that was fun. But now I'm like, what if I thought about building an edge over 20 years? And that's what I'm doing now. The formula, goal equals time times your edge, right? So if you have a goal, it really comes down to how long it's going to take you to get there, multiplied by how good you are at the skill that is required to get there. And that's just like, it's hard. I love it. It takes a huge amount of energy and a lot of discipline, but like what else is a better investment, right? It's like the investment. So that's what I'm up to. Well, thanks guys. Thanks for sticking around. This is like, gosh, I don't even know how long this is, maybe an hour plus. I have no idea how much I'm going to upload these videos for the reasons I just said. I'm just like focused on a lot of other stuff, but I do think it's a lot of fun. I think whenever there's another big kind of reason to make a video, I will definitely do that. I'll try to be active on Twitter. You should go check out Twitter, Carter Thomas. Try to keep it mostly serious and fun. Sometimes I just like screwing around, but yeah. In the meantime, I hope you all have an amazing day, amazing week. Yes, crushing it. And I will catch you guys later. Peace out.